Hi everyone, and welcome to the Buffett and Beyond weekly stock analysis video. And I know we're putting out more than one stock a week, so we'll just have to change that weekly into daily, I think. From now on, we've just had so much action in the stock market. But these methodologies are based on the book Buffett and Beyond, second edition by Dr. J. Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And this week, well, we're going over a stock in the e-commerce business, and that is Salesforce.com, and that's because they just came out with earnings that beat expectation. Problem is that their forecast for the rest of the year wasn't too hot, and they told the world that sales were down and some other costs were going up, so it's not an overall good picture for Salesforce.com, at least right at the moment, and it was down about 6% in the pre-market trading just before recording this. So let's see what Salesforce does. It's a leading provider of on-demand customer relation management, and that's what CRM stands for, and it's also their stock symbol. So CRM services, customer relationship management. It is a cloud-based software company that offers services to manage and share information regarding sales, customer service and support, marketing operations, and data analytics. Now, let's look at the blue lines, which are the stocks or the average stock in our 1,800 stock database, and see how Salesforce compares with that, and the green lines represent Salesforce numbers. Now, the clean surplus ROE, the first line on the left over here, shows that the clean surplus ROE is higher than the market averages. So that's a good point. Now, we get to net income. You'll see 13% average growth over 5 years for the average stock, but you don't see any green line for Salesforce, and that's because it's very, very erratic, and we're going to show that in the next slide. Now, with revenue is twice as much as the average stock. Average stock about 7.1%. Revenue for Salesforce over 5 years is about 15%. So all in all, it looks good from this chart, but we have to look a little bit further. And here we are, and I know some of you don't like numbers, but let us look at the net income. Now, net income is the clean surplus earnings. You take traditional accounting earnings, subtract out non-recurring items and future liabilities, and you come up with net income. You come up with a cleaner earnings number so we can compare one company to another, because those non-recurring items that I mentioned, there's a lot of them in these big companies, folks. And when I first started my research on this exact subject, I said, how many non-recurring items can there be? I was surprised. In fact, it gave me enough information to write a 200-page doctoral dissertation on the subject. But let us look at these numbers. Now, in 2020, this stock had $4.38 of net income. Then for 2021, now don't forget, 2020 was the year of COVID. It made a lot of money. And then 2021, it fell down to $1.48. 2022, which was a bad year for the overall market, down to 21 cents. Now, for 2023, projected to be $1.50. But we'll see how that transpires as we go along, because they just came out with numbers and they said the rest of 2023 is not going to be so hot. So this number could very well be reduced in here, because don't forget, our numbers that we're showing you are yearly numbers. And then if this year's numbers are going down, their forecast for 2024 is also down. They didn't make a forecast for 2024 yet, but we expect this to drop. So we look at the clean surplus return on equity so we can compare it with other stocks. And look, down here, 49%. Then as we come up, 11%, then 1.4%, and now it's starting to rise again. Now remember, the average stock has a clean surplus ROE of about 13%. But look at the 3, 5, and 10-year averages. Let's look at the 3-year average of 8.76%, 5-year average 17%. So in other words, this ROE is getting cut in half. That's not a good sign. We don't like that. And we come back here to net income, and we have the net income or clean surplus earnings all over the place. And folks, when the market looks at that, or we look at that, we are the market participants, we look at that, we say, we have no clue what it's going to make in 2024 or 2025. It doesn't have nice, steadily rising earnings, and therefore the market does not know how to price a stock that has nice increasing, steadily increasing earnings, like a Google, like a Microsoft, those kind of stocks. So we look at Salesforce.com, and right away we're looking at the clean surplus ROE all over the place, and we don't like that. We don't know how to value this stock. Now, when we come over to net income growth, we can't give a 5-year average on that. I mean, look at these numbers. A 2,820% increase, then a 66% decrease, then an 85% decrease, then a 600% increase. Folks, this is not a company that we can rely on to be consistent in our growth portfolio. Because remember, our growth portfolios, we want to be able to look at a stock and put it in our portfolio. And the question always comes is, how long do you leave a stock in your portfolio? Well, first of all, we pick good stocks, and we leave that stock in our portfolio until it's not a good stock anymore. It's that simple. It could be 1 year, it could be 10 years, it could be 15 years. And remember, O'Reilly and AutoZone and Microsoft, some of those companies, they've been in our portfolios for a very long time, folks. Salesforce.com, we don't know if it's going to be in this year or next year or the year after, and therefore we're not even going to take the chance on that. We don't want to have to worry that much about our growth portfolio. And when you look at the clean surplus ROE, remember, you are looking at a bank account. So would you put your money in a bank account that makes 11% 1 year and then the next year only gives you a 1.4% interest rate? I don't think so. You don't want one that's all over the place. You want to see nice and consistent. Now, revenue growth, even though a 5-year average is almost twice as high as the average stock, next year, 2024, is projected to be just 8%, which is about average, a little bit above average. But with the numbers they just came out with today, and I'm talking about on Thursday, then, folks, we have to be wary of this revenue growth for 2024. Very wary. So we look at it that way. Years to pay debt, 3.8 years. That's a little high for us. Well, what is years to pay debt? If you take all of the money a company's making and use it to pay off debt, how many years will it take to pay it off? Buffett wants 5 years or less. We want 3 years or less. So for us, this is a very, very high, well, I shouldn't say very, very, it's very high years to pay, number of years to pay debt. So therefore, there's a lot of things we don't like about this stock, and it all stems from the erratic earnings, or a clean surplus earnings, which is net income, very, very erratic, which gives us an erratic clean surplus ROE. So if we don't know what next year is going to bring, we're not going to buy that stock, and neither are a lot of market participants out there. You don't think for 1 minute that all these pension funds, where these money managers are responsible for billions of dollars of people's retirement money, that they're going to put a company like Salesforce in those portfolios. Maybe a little bit, maybe a few shares, but not very much at all. So therefore, we don't like Salesforce.com. Now let's see how it's done over the past 5 years. Black line is the S&P 500. So we're looking at a stock that outperforms the S&P 500 and then drops way down in the past. This is 2022, this whole sector in here. So we can see that at the end of 2021, this stock started to drop, and it really dropped. It's coming back nicely now, to be sure, but we don't know, the market doesn't know where this stock is going to be relative to earnings the rest of this year or next year or the year after. So therefore, why would you get into a stock that is overall barely outperforming the S&P 500, and you're putting all your dollars on one stock when you can buy the S&P 500, or in our growth portfolio, where we've been returning over the past 22 years almost 3 times on a compounded basis more than the S&P 500, and twice as much as Buffett's Berkshire Hathaway portfolio on a compounded basis. So You want to put good stocks in your portfolio. You want to put consistently growing stocks in your growth portfolio. And I'm sorry, folks, but Salesforce.com just does not fit the bill. So, folks, remember, if you want to sit on the beach like Jimmy Buffett, and this is a picture of Cape Cod Beach, by the way, you want to sit on the beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And that's what our growth portfolios and the clean surplus methodology is all about, picking those stocks that are better than average stocks. All right, folks, stay well, and we'll see you back here next time.